you've given me so much value, and I know I have a question for you, and I hope you can answer it. I don't know where, because I seem like every question I ask you, you're ready, you're surefire. I think I have one that'll probably stump you a bit.
Oh my God!
And we're gonna bring Grant. I know, probably. We're gonna bring Grant Cardone into space. We're gonna pretend Grant Cardone is sitting right here next to me. He's always talked about it. He spoke about it multiple times. I've heard him say that he wants to take his real estate company public, right? So if Grant Cardone comes to Mr. Gordon Bazar and says, Gordon, what would be the best strategy for me to take my company public? What would you say to Grant Cardone?
Okay. Funny you should ask.
Yeah. I didn't stump you?
No.
Oh my.
I'm ready.
All right.
I'm ready.
Let's go.
All right. Well, here's the real estate model for today.
Yeah.
Okay. Not 20 years ago.
Okay.
Not 10 years ago.
Okay.
Not even last year.
All right.
This is it.
Today.
State of the art, man.
Okay.
State of the art.
Yeah.
Okay. If you're going to take a company public, the first thing you got to ask yourself is what creates value in the public marketplace. It's not assets like real estate. Mm-hmm. People don't buy a public company because it's got assets. They buy it because it has earnings. Okay, and the companies are sold on something called a PE ratio, price earnings.
Okay.
So let's say a company makes $1 million in net, okay, and it sells at 20 times earnings in the marketplace. That's a $20 million company in value.
Oh wow.
Okay.
Okay.
Because it's 20 times their PE. So when you're buying stock in the company, you take all the stock of the company, you divide it into $20 million, and every share is worth that fraction amount.
Gotcha.
Okay, and that's how it gets priced. It's based on an industry-wide price earnings multiple applied to that company. Okay? So, if Mr. Cardone wanted to go public,
and he does.
Okay, he would go to somebody like a Morgan Stanley or a Goldman Sachs, okay, and they would look at his numbers and they would decide, okay, if we took your company public, here's what it would be, and Grant would sit there and he would say, well, okay, it's worth more that way than it is just with my asset values, so I'm going to do that, okay, and he's leaving 90% of the money on the table when he does it, okay, all right, here's the other 90% of the money. You take your real estate company and you break it up into two companies, okay, one company owns the real estate. One company leases the real estate at a below market rate of rental. This company then releases it at the market rates and makes a lot of money.
Right.
Okay. This is the company you take public because it's got nothing but earnings, no assets.
Right.
The assets are over here.
Okay.
Then you have investors in these assets who want to own it because of the tax write-off, who want to own it because eventually it will be sold, and when it's sold, they get their appreciation.
Yeah, because the assets are there.
The assets are there.
Yeah.
Okay, so you take the typical real estate investor and you put them on this side, and then you take the public and you put them on this side, and now you not only have the asset value here, which still has the asset value, but you've created this public entity which is now going to sell at, let's say, 20 times earnings, and it has no assets.
Right. Wow. Because you don't need it to be public.
Okay. So you created two entities that together have 90% to 100 to 300% more value than if you